Fraud by crime syndicates located overseas and organised crimes are key money laundering threats that Singapore faces. That's according to an updated national risk assessment. The report also highlights that the banking sector poses the highest risk to Singapore. Geraldine Yap tells us more.
The last Money Laundering National Risk Assessment, or MLNRA, was published 10 years ago. Since then, the landscape has become more complex. Technological advancements have made it easier for criminals to move illicit funds across jurisdictions.
Singapore continues to be exposed to key foreign money laundering threats, namely corruption, tax, as well as trade-based money laundering. In addition, cyber-enabled fraud, popularly known as scams, as well as foreign organised crime are two new key money laundering threats of concern, posing significantly higher risks than that was observed in our last NRA.
The banking sector still poses the highest risk of money laundering, given the high volume of transactions and cross-border networks. Other sectors to note include digital payment token service providers, due to an increase in reported cases where tokens were used to transfer illicit funds, and firms dealing with precious stones and metals, which are high-value assets. The Monetary Authority of Singapore says many sectors have improved their controls and risk awareness over the years, but more can be done.
The global threats as well as risk environment have actually also increased in complexity. It is therefore important for industries as well as sectors across the economy to ensure that they pay attention to this MLNRA, take reference from it to actually ensure that their risk assessments are up to date, as well as to ensure that their mitigating measures are effective as well as sufficient to address these risks.
These findings will also guide ongoing efforts to ensure that Singapore's anti-money laundering regime keeps up with the risks.
And for more analysis of this assessment, we're joined on Zoom by Anke Raufuss, a partner in McKinsey's risk practice. Ms. Raufuss, given that this comes on the back of the recent billion-dollar money laundering bust, does this review update on existing practice to match what they have learned from this bust?
Yeah, so money laundering or broader financial crime risks, they are not a new thing. So in that sense, we've seen them before at global scale, and they're always serious and to be taken serious. And I agree with what was said in the report. A lot has been done. In particular by banks. They've built capabilities to actually spot those crime cases, but there's still more to be done. And whenever there's such an incident happening, it is prudent to review, on the one hand, the regulatory requirements. Are they still fit for purpose, in particular as new technologies and new digital payments, as was mentioned in the report, are coming in. Number two, do the institutions have the adequate governance and processes, policies and tools so that they can actually spot suspicious behaviors? And then thirdly, do the institutions also use those tools in the best and adequate way? Do they have the right capabilities? Do they have the right culture to actually be fully focused on getting those criminal cases identified?
Well, Ms. Raufuss, in fact, this answers in part my next question, but these 3 points that you raise, they are part of how any assessment determines how at risk any institution is. But if you could pinpoint the key factors one uses to determine how at risk an institution or a country is, what might these factors be?
Yeah. And those factors are much debated and are put into quite sophisticated models to help really determine individuals or institutions. We call it customer risk rating. They are also kept quite secret and not shared widely so that no one can play the system. But in general, there are a few factors that are really driving it. Number one, what is the channel that you're engaging with your customer. Is it an in-person contact? Is it digital payment, for example? Then the geography plays a role, and that's the country of domicile, that's the country of citizenship of an individual, or even the mailbox country of an institution. It's about the product. So what kind of product are we selling here? Is it a wealth management product or any other normal banking product? And then the customer itself, what's the occupation, what's the industry sector they are working in, and so on. And lastly, the transactions. So the patterns in the behavior of customers. So do they use cash? Do they use wire transfer? Do they use strange patterns in the way they distribute money? All of these are coming together and are bundled together in a customer risk rating that is then continuously monitored and tracked. And there are, if you look at those factors, there are then higher risk customer groups or also sectors versus others. So we are seeing higher risk in the high net worth individual customer group or in the small medium enterprises versus maybe the retail customers or the corporates, which are typically much more under bigger scrutiny, public scrutiny anyway. And similarly in sectors, the typical examples that you see there as higher risk are the casinos, gambling, art dealers, charities, real estate. Those are then always put under a bit of higher scrutiny by the banks to see whether they have good customers.
Ms. Raufuss, you mentioned the need for regulation to be fit for purpose. In a way, regulation is always trying to keep up with imaginative and creative ways to, I suppose, get around those regulations. How will existing measures have to be adapted to keep up with projected new challenges on this front?
Yeah, it's a very good question, and I think I would say two things. One is innovation. So indeed, the measures and the regulation needs to consider new tools, new technology, new analytics that needs to be put in place, and that is what is happening. What we're seeing in the industry, that organizations are using AI, machine learning, network analytics, perpetual KYC, so continuously having a real-time view of how the customer risks evolve, and all of that in view of the digitization, because also the fraudsters and the criminals are ramping up their game. It's a little bit like Cold War. Everyone has to increase their remit. So innovation is one part of it, and collaboration is another. And collaboration meaning both within an organization, within a bank, there's even different groups, whether you think about the financial crime group, the fraud group, the cyber group, all of those groups need to work together, but also across institutions, across the banks. They should share insights, they should share what typical patterns are that they spot, so that everyone can be aware, so that we make the whole financial system safer. But also collaboration with the authorities, between banks, financial system, authorities, and regulators and government. So those two, innovation and collaboration, I think is which will help us continuously improve and
A final question, Ms. Raufuss. The fear, of course, always is that regulation, and this may not always be true, but regulation will cut the desire or the scope, as you mentioned, for innovation and collaboration. In this instance, is this a genuine fear? Will business go elsewhere if they feel there's just too much scrutiny?
Look, I think it's similar to going through security at the airport. It is obviously a nuisance. You would want to go much quicker to the gate, but you go through it. You get into the queue, put your suitcase on the trolley, and get screened. It's just what you do in order to make the whole system safer and to fly safer. And similarly, in regulation, or in also what the banks now apply in terms of screening their customers before they open an account. It might take a little bit longer until you can open your account, until you get to your money. But it is in order to make the whole system safer, and everyone is working to make it not a nuisance for nuisance purpose. It's supposed to really help reduce the risk and make the whole system safer. And I think people understand it typically, that this is just part of the safety measures that we need.
Oh, thanks for that. Ms. Anke Raufuss, partner in McKinsey's risk practice. Thanks for joining us this evening.